Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Tuesday, March 11th, 2025. Today's episode's main title, the S&P 500 toys with correction territory. The stock market, typically defined by the S&P 500, when it is in a correction, it means that it is gone down 10% or more, and on a closing basis we haven't reached that, but we basically touched it today almost exactly from the all-time high. And intraday today, here it says 9.98%, but I'm pretty sure it's basically exactly 10% there at the very bottom. Obviously a bunch of traders saw that and jumped in there to, I mean, day traders, what they often do is they'll get a buy level that they set, and then they'll get out like soon as it goes like just even a penny in the money, because, when you're guaranteed to have a lot of buyers at certain levels, it's just easy profits for them. And yeah, so I think that may be what happened here today. Once we're solidly below this 10%, well, once we've solidly lost 10% on a closing basis, I'll say, then we are sitting in correction territory. We're not in correction territory yet, but we played with it today. If we go down twice as far to 20% or more, then that's considered bear market territory, anything below 20%. Next agenda item today, the yield curve is just so wonky. You can find this at USTreasuryYieldCurve.com. It shows an excellent snapshot of what the yield curve currently looks like. As I've been mentioning, the 3-month is above the 10-year and how that's back to an inverted state. However, when you look a little past the 3-month, you can see 4-month, 6-month, 1-year, 2-year, 3-year are all much lower than either of these, suggesting that the curve as a whole is still seeing rates dropping over the next 2 to 3 years right now. I find it useful to take a look at the whole curve every once in a while, really to get a bigger picture of what it looks like. Because sometimes, normal state, it's low on this end and high on this end. Like, that's the normal state. And then when it's inverted, has any kind of inversion going on, it's the market saying that it's expecting the front end to be lower eventually, because the Fed is holding rates too high to be sustainable. So as it is being so wonky all over the place, and the middle dipping down so far, the whole curve is still saying that it sees rates going significantly lower. Next agenda item, CPI comes out tomorrow morning. Very important numbers. Consumer Price Index. This is a measure of inflation, and we have PPI coming out on Thursday. I'm very curious how it will come out and how the market will react. We also had job openings come out today. Not much news there, but I'll cover it when we get to the charts. Next main agenda item, the community topic. Someone brought up, and thank you so much for your comment. Thank you for everybody's comments. I love all the comments. I read all of the comments, even if I don't react or comment back or cover on the show. I appreciate all the comments. Love hearing how people are thinking that are watching this show. Gives me an idea of how to talk about things in a lot of ways. Anyway, one commenter discussed how the uneducated economist, another great YouTuber, besides me, who talks about markets and how, copper staying elevated is sort of saying, okay, yeah, there might be a shorter term, turn down, but then after that, it's expecting, strong copper price, that the economy is going to be fine coming out of this. That's what Dr. Copper sort of saying now. And, so the cost of carry, what is that? So the person on the comments brought up the divergence between oil seeming like it's going to crack down to, maybe not as far as negative $35 a barrel as it got at the bottom of the COVID dip, but, down to $35 a barrel potentially, and why copper is just staying, relatively elevated. Yeah, there's a cost of carry. Oil, copper can't ever really go to negative $35 a pound because there will always be people that can buy and store copper. I'll buy and store copper. I'll buy as much of it as I can. I can fill up a room with copper, and I don't have to worry about it leaking out or having an enormous amount of space for it, or having some kind of disaster happen with it. Yeah, the cost of carry for oil is huge, and that helps explain that divergence. Thanks for that comment there. Also, thank you everybody for watching, subscribing. Don't forget to subscribe. I'm so close to that $1,000. It's not $1,000. That 1,000 subscriber goal post. I really would like to get there. I don't care so much about getting much past there. I kind of want to just be able to maybe monetize the videos, or at least have the ability to do that, maybe on just some of the videos. Not sure yet. But anyway, subscribe. And also thank you for all of the other support. It is deeply appreciated. Watch Macro Update 21125 to hear me explain the daily reminders. And watch Portfolio Update 21125 to hear me explain my crystal ball readings and my portfolio. No real updates there, although I did actually sell the TLT calls because they went up a lot when TLT went up. So, when you make a bunch of money in something, if it goes up 100%, like, why not just, take it and run? Good job. You made some money. Part of the reason I bought them in the first place was I was expecting the unemployment rate to potentially shock markets, and it didn't. And so, I was happy to exit at a, handsome reward, as Benjamin Graham might say. So let's move on to the charts. I already showed the S&P 500. The next thing I wanted to bring up was the job openings, total non-farm roll. This came out today. This is how many job openings are there. If this is like really collapsing, that's typically during a recession. Notably, since 2022, like I always say, this has been collapsing. But because it was so high in the first place, it doesn't really matter. I mean, in terms of a percentage, you take a look at the beverage curve. We peaked all the way over. Let's see. The highest it got was 7.4% job openings rate. That's huge. Anyway, the main data that came out today was job openings are at 7.7 million job openings today. So it's not continuing to fall off of a cliff here. If this stays flat, then yeah, this metric by itself is peachy by itself. And I haven't brought up the beverage curve in a while. It was something Powell brought up himself in a meeting, I don't know, a few months ago, 6 months ago, something like that. He says, the Fed is watching this because, when this shows a job openings rate on this axis and then the unemployment rate on this axis. So obviously, the unemployment rate is the most important thing, but one thing that can lead that is if we're dropping in job openings, eventually, we can curve out the way most, slowdowns or recessions have done so in the past. And you can highlight like different areas, like obviously the yellow one is a notable one, being the Great Financial Crisis. Just to look at this one by itself, starting in January 2008, we had a job openings rate of 3.2 and unemployment rate of 5%, and then it just kept going and going and going in that direction. And today, let's see here. Today, from May of 2020, where there was the COVID shock, all of a sudden we had it going up like this, and now we're going down. And so when things are really falling apart, that's when it's going like this way, and it hasn't shown that yet. And this is one of the reasons why I still feel like we're on the edge of the storm, but we're not actually in the storm yet. Unemployment has to spike really if we really are in a recession. I still think that's coming, but it hasn't come yet. I wanted to bring up the VIX is still highly elevated. We if we are seeing a market bottom here, we definitely need to see the VIX cooling off here. And as it stands, obviously the futures curve is completely inverted still. So we're still in panic fear mode. One chart that caught my eye today, and something that I like to use as a contrarian indicator, in other words, something that the market is doing that can often indicate that something opposite is going on. This represents out of the money put contracts. Obviously, as this falls, it means part of it is that there's more put contracts in the money now. I mean, obviously. But the bigger thing here for me is that people aren't loading up on further out of the money puts right now. And so that's why I like to use this as a contrarian indicator, because what it tells me is that the biggest money are the ones that are actually selling these puts and winning, by selling them. And so, the institutions can now not have to worry about their puts printing as much because there's less interest and the price has gone down for them. And so for me, that's kind of an indicator that it sort of can allow the market to perhaps even fall further from here. So I am bearish on the S&P 500, and I'm not betting on it other than just still believing that treasury bonds are still they're my favorite place to be. TLT, my favorite place to be, like I say on every show. I think the bond yields are way higher than they can sustainably be for 1.5 million reasons. I also wanted to bring up the advanced decline line. This can help support if the market may continue to be bearish or bullish. With today's market action, we finally got a lower low in the advanced decline number. This suggests that this really is a continued move down. When you get divergences, for example, if it's going down and you get higher highs and higher lows, that can indicate that maybe there's a reversal here. But today's action on the advanced decline line says to me that there's still more downside here. There's no updates or much to talk about with oil other than, we're flirting with this $65 a barrel price. And, some people think we might get a bounce here and then have the final flush. Again, the trend line here, $65 or the one that I drew. I like mine better than the 65 one, but there's smarter people than me that believe that 65 is the real key number here. Any which way about it, this area has been held up since 2021, and we've just been pounding on it, trying to break lower, and haven't been able to. And me and my crystal ball say this is the final push to the downside, that we will have a collapse in oil prices soon. But that's just me and my crystal ball, and that's the second to last chart I have to share with you today. The last chart is simply junk bond credit spreads now widening above 3%, so 3.16. If we zoom out on this, this is still very, very, very tight and very, very low. I've been talking a long time about how unbelievably low it had been going, like historically low, like never seen before type low, except for right before the great financial crisis. Anyhow, when we zoom in on this, credit spreads are spreading, and so there's fear in credit markets finally. And this is one of these things that gives support to the idea that maybe things aren't as peachy as the market had been pricing things. Since when did this get ridiculous? Since November of 2024, when we let me show the chart. When we dropped to this crazy low, 2.63%, and then bouncing along in this area, like everything's fine, that you can lend money to your neighbor's dog and only get like a tiny bit extra return, like ridiculously low levels. We're finally spreading a little bit here. And, from a chart pattern, this is a spike to the upside. I don't know if this is going to pause. or just continue spiking from here. If the S&P 500 does continue to fall, that can also scare credit markets, obviously, and this can, you know, yeah, this can widen, and then yeah, it supports further. Like, yeah, things are really not okay. That not only have we heard the ice crack, we see the cracks in the ice, but now we're seeing water come up through the cracks, kind of a thing when the credit markets start really falling apart. We're not really falling apart yet, you know, until we get much wider in the credit spreads, but much wider. But anyway, we're going in that direction. And that's all for today, and that's all for me and my crystal ball. Don't forget to subscribe. I want to get to that 1,000 subscriber mark as soon as I can. Thank you for watching. Thank you for subscribing. Thank you for all the support. And see you next time. Robschild.